So, good afternoon, everyone. Thanks for joining us, and welcome to the second instalment in the BWD Boardroom series. My name is Kieron Snow, and in today's session, I'm lucky enough to be joined by an illustrious panel who will be discussing all things ESG, ethical and responsible investment related, and specifically looking to answer the question, do people really care about ESG? So do please feel free to submit questions via your chat facility function. I will do as best as I can to ask as many to the panel and hope to make this session as interactive as possible. So I'm delighted to be joined today by Kieron Shackleton, who is the founder and head of Pensions for Purpose, a collaborative initiative to raise awareness of responsible investments within the pensions industry. From its creation in 2017, Pensions for Purpose now has nearly 200 members and affiliates and provides an invaluable knowledge and resource centre within the industry. I'm also joined by Andy Seed, who's head of ESG Solutions at Aviva Investors, a prominent name within the UK pensions industry with over 20 years experience, having held senior positions at KPMG, Scottish Widows and JP Morgan, amongst others. I'm also due to be joined by Paul Black, who's having a few technical issues, not currently on the screen, so you may not see him. Hopefully Paul has joined us very shortly. Paul's a DC investment manager at Hargreaves, Lansdown. Paul has previously worked as a professional trustee and also as an investment partner at Quantum and LCP, and is a well-renowned expert within the field of DC investments. And last but by no means least, I'm joined by Eva Grace, who is an investment consultant working at Barnett, Waddingham. Now, Eva speaks with a variety of DC and DB pension schemes on a daily basis, and it'll be really interesting to hear her views on how important ESG is to them. So, even 5 years ago, ESG, or green or ethical investments, was very much an AOB item on the agenda for many pension schemes and providers, and was seen by some as a bit of a fad driven by tree-hugging lefties. Since then, though, it has risen quite rightly sharply up the agenda for many clients, providers and regulators, and is now a core part of the investment strategy for many, with ever-increasing member scrutiny and focus. So to get things started, I'm delighted to pass over to Kieron, who's going to give us a bit of a high-level overview of what ESG really means and the different approaches that can be taken.
Thank you, Kieron. Just want to check you can all hear me. Can you nod, Kieron, if you can hear me?
I can.
Good, great. So good afternoon, everybody. Really nice to be speaking this afternoon. I think if you spoke to 5 different people about what does ESG mean for them in an investment portfolio, you would easily get 5 different responses, different interpretations of what that actually means. And I work with a lot of pension funds, helping them with their investment beliefs. And I like to frame it in terms of the spectrum of capital, which some of you may be familiar with already, but if you're not, then I'm going to just give you a brief explanation of what the spectrum of capital is. So at the bottom of the spectrum, on the left-hand side of the spectrum of capital, you have traditional investments. And this was where we were sort of 10, 15 years ago, focusing purely on the financial goals of an investment, with very little consideration as to the impact of our investment on the environment or on society, on people and the planet. At the other end of the spectrum of capital, you had philanthropists. Now, philanthropists might even have been prepared to lose all their money, provided they could get the impact that they wanted. So they would want to be investing in the environment or in social initiatives to have a positive impact on people. And the spectrum of capital is, as you would imagine, a sort of gradient shifting from these financial goals through to the impact goals. Now, where we are probably for most of us at the moment is in the responsible investment part of the spectrum of capital. And that is probably the closest definition to ESG that I would think of myself. So this is where fund managers are taking into account environmental, social and governance risks when making their decisions about what stocks to hold and what stocks to sell. And so it is part of the decision making, the financial assessment of a company, and it's done in terms of assessing any risks, threats or opportunities arising from those ESG factors. But what we're seeing in the industry at the moment is a shift further along the spectrum of capital. And you can do that in 2 separate steps. You can move from responsible investment to sustainable investment, which is more of a thematic type approach. So this is where you might, for example, start to disinvest from certain sort of sin stocks, if you like. You might decide that you want to have a climate strategy. So you want to either exit fossil fuels completely or certainly de-weight them in your portfolio. And you might want to start tilting towards more environmentally friendly companies. That's called sustainable investment in the spectrum of capital. But now funds are going one step further still, which is to start thinking about investments that have a positive impact on society or the environment. And in the climate analogy, that might mean, for example, investing in a renewable energy fund, which is specifically trying to improve the environment and carbon emissions. You would go from impact investments, which is this bucket of investments that have a dual goal, a financial goal and an impact goal. And you would then move further along the spectrum of capital, and gradually returns would start to be being eroded until you got into the philanthropic part of the spectrum. So when I'm talking to pension funds about ESG, we begin by talking about the spectrum of capital, and I help them then articulate a set of investment beliefs that allow them, should they choose to do so, it allows them to move along the spectrum of capital so that their capital is becoming more purposeful or even intentionally trying to have a positive impact. That's probably enough from me for one session, Kieron, so I'm going to hand it back to you now.
No, thanks, Karen. That's really interesting. So there's a lot more to ESG than meets the eye then, is what I'm taking from that. So probably a question now that I'd like to ask to Andy, probably. There is a sort of feeling or understanding out there that although it's great to invest responsibly, it comes at a cost in terms of investment returns. Do you think, I'd be interested to get what your views are on that, if that's okay?
Sure. I think, yeah, I couldn't agree with Karen more around sort of asking different people around what ESG kind of means to different people. And I'll come on to that in a second. But I guess from my perspective, I think you need to think about this in a DC context, that a 20-year-old joining the workplace now is going to be investing for a period of time for the current state pension age maturity until at least 68. That means they're running a 48-year plus investment time horizon. So I think you've got to take this back and mainly focus on the E in us answering this question. And a number of bits of research out there, but there was a piece that Aviva Investors commissioned with the Economist Intelligence Unit. It's a little bit old now, but back in 2015, that basically said that the outcome was that if we're living in a world that's contributing to a sort of 6-degree rise in temperature, that the value at risk associated with that, effectively, if you put a number on that, that's effectively equivalent to 43 trillion of assets at risk directly as a result of climate change. Just to put that in some sort of context, the UK retirement and savings market value, DC and DB, and other retirement savings, including ISAs, is 4 trillion. So we're talking about 10 times plus the entire value of our market as terms of global assets of value at risk. So the short answer is, for DC savers joining the workplace now, if we're contributing towards that sort of increase in temperature, there isn't going to be a world left for them to draw assets down to live in. So I think we've moved from a world where ESG is nice to have to a world very much where ESG is a compulsory and quite rightly mandatory thing for us to include. Your specific question, though, Kieron, was, there perhaps is a myth that the historically ethical investing, as Karen described it, perhaps comes at a bit of a premium in terms of loss of annualized return. I think going back to that argument, though, that managing money responsibly is the only way to preserve our planet, let alone businesses more generally. I don't think it's a nice to have anymore, and I think actually we're seeing that it's not just the E but also the S and the G that companies are focused on in terms of how they run their own board structures and entities to get returns. And if we think about where institutional investment money is secured, largely for the sort of shareholder capital of these large companies that comprise the FTSE 100, those companies are not going to get investment if they don't pass the ESG sniff test. So if they're not being invested in, then guess what? You're not going to get the returns. So I think over the short term, and perhaps historically, if you look at sort of ethical stewardship type investment, and of course we're a big player in that market, I think it's a fair observation that relative to perhaps other asset classes or other ways of investing in multi-asset, there perhaps has been a sort of relative return comparison that you could make that would surmise perhaps you give up a bit of return to get the ethical outcome that you're wanting to achieve. In reality, though, it's not a nice to have, and the E is just one bit of the puzzle. The S and the G are equally as important. And I think how investors and investment managers like us deploy the voting rights that we have over these companies, but also monitor and secure the social aspects of how the boards are treating staff, etc., equally as important. This is a very new area, to Karen's other point, that we're trying to bring some standardization to an entire industry that looks at this problem in massively different ways. So, I mean, just to give you an example of that complexity, if we think about a multi-asset portfolio and how it's constructed, you've got certain common things that you can measure and benchmark against. So you've got the MSCI, for example, but take different asset classes like, treasury bonds, for example. How do you put an ESG score on, I didn't want to single Mozambique out here as a country, but for example, how do you gauge Mozambican bonds relative to US treasury bonds, etc.? And how do you put an ESG score on that when your portfolio comprises so many different things? And that's why it's really, really important that responsible management of money needs to comprise the right benchmarks, the right attitudes to ethical investing and ESG more generally, but also if there aren't benchmarks to allow you to compare apples with apples, you're going to need to invent your own proprietary scores to make sure that what you deliver through a portfolio is fair to consumers. So I think, yes, perhaps historically ethical, or was it you called it tree-hugging lefty investing, Kieron? I think those were your words. Perhaps might have come at an expense, a premium of returns, but I don't think that's going to happen going forwards.
Okay, thanks, Andy. So it sounds like really we can't afford not to invest responsibly now, and it's just part of a sort of overall piece and not an if or then. Well, I think Paul has joined us. Paul, are you there?
Yes, I am. Thanks.
Oh, excellent.
And apologies for technological problems earlier. I've just heard. I missed what Karen said earlier, I'm afraid.
So off the back of that, Paul, maybe you could have to answer what are providers doing to tackle ESG issues, and to what extent is this driven by the members' demand? So do they really care? Are you getting demand from your members, and is as a result of that, what are providers doing in the market?
Yeah, sure. Well, firstly, I think all providers, in fact, everybody, the entire market now, I think, is taking it seriously. And I contrast that with, if I go back to a previous role I had 7 or 8 years ago, I sat in the Responsible Investment Committee for a firm consultants. We would talk to investment providers about responsible investment, and quite often you just get a very blank stare. When you didn't get a blank stare, you got some words which sounded encouraging, but when you looked at the actions, actually very little was often happening. And now I think it's not like that at all. The fact that ESG is so mainstream, but I think people talk about greenwashing, but most people now, to my mind, are taking it seriously because they have to, in the way they certainly weren't 5, 6, 7 years ago. So what's happening in the private area for HL, where I am, my role is I'm responsible for our group pension investments. So one of the key things I'm working on is designing a new default strategy. And ESG and integration of all the ESG themes are going to be absolutely central to that default strategy. I think even going back a year or two, a lot of providers would make available ESG options and say to employers or to members, if you're interested in ESG, then here's something for you. I think now we're moving to the stage of provider have to say, actually, we think this is a huge financial risk, which we need to manage because we are the investment experts. So, and we know that most people will stay in the default. So the default strategy has to have ESG fundamental to its core. And that means higher weights to companies that we think manage ESG issues well, and lower weights to those that don't. Not necessarily easy when we have things like the charge cap regulation pushing us generally towards passive funds, but still I think it is possible now, and I think the industry is starting to move in that way. The other thing, come back to your point about what members think, when we start talking to members, and particularly where we're planning for when we're launching a new default strategy shortly, to say to members, and we'll start to talk to them about this is what we mean by ESG in the context of how we're framing it and reflecting it in our default. I think that will get a huge amount of interest from members who are saying, actually, okay, yeah, now I can see that my pension fund is investing responsibly, but maybe it's not in line with my own aims and objectives and values. So if I care specifically about the environment, about diversity, about any other of these sort of ESG issues, then we can then make available and point members towards options that they can easily sort of invest in line with their own objectives. So I think it's very much two levels. It's the default strategy has to be ESG integrated, but then we've got to make it very easy for members to actually reflect their own ESG priorities as well.
Okay, thanks, Paul. So the default's important, and I think from what you're saying, it's up to the industry really to take the lead on this and not expect members to. You can't have an individual member, but for us to pull something together that works for everyone.
I think that's right. It is a huge financial risk, and I think if we as an industry are not taking account of and managing assets in with that financial risk in mind, then we're doing a disservice to members.
Okay, thanks, Paul. So, Eva, over to you, really. As an investment consultant, of course, you get to speak with clients on a daily basis. So, I guess the question to you, similar lines, is do your clients really care about ESG? And maybe is there a difference between when you talk to trustees or members of DC schemes as opposed to DB schemes? Or for some, is this just a tick box exercise? I'd be interested to get your thoughts.
Yeah, sure. It's a really good question. So we're seeing that clients are interested in ESG, and they do care about it for a couple of reasons. The first is that they're being forced to think about it and care about it by legislation, which is going to come into force to make sure DB schemes and DC schemes consider ESG risks as part of their looking at their investments. So we're seeing them have to do it from a tick box perspective, but a lot of them also really care about it as well. So in particular, we work with local government pension schemes who care about it in a big way because of the government, of course, declaring climate emergency. And so how do they then align their pension funds with that and invest in a way that kind of aligns with that? So they're very engaged with it. Other pension schemes, for example, universities are under a huge amount of pressure from student activist groups. So they're being put under pressure not only in terms of their endowments and their own investments, but their pension fund investments as well. So we're seeing a lot of examples of universities disinvesting from fossil fuel companies, or tobacco as well as another big one in the news just the other week was USS, who have now decided to disinvest from tobacco. And actually, it's obviously a huge scheme, but it's behind the times compared to other university schemes who have maybe been disinvested from tobacco for quite a while. In the private sector, it's kind of mixed. So some pension schemes are really embracing it, and others are kind of being forced down the route of embracing ESG because I suppose one of the issues is it doesn't really matter if you believe in it or not. Once a big enough tide of people is moving that direction, you want to be on the right side of it. One big issue for pension schemes has been the lack of availability of funds which they can use to invest in a kind of ESG friendly way. So passive investing is obviously a huge, is used very widely by pension schemes, and until quite recently there haven't been a huge number of options to invest in an ESG passive fund. In fact, there's only just now being passive funds being made available that are kind of aligned with the Paris Agreement temperature target there. So that's been quite a big issue as well. But we're seeing progress in that area, and it's quite exciting to see all the funds that are being launched, which can be used by pension schemes. In terms of DB versus DC, there's Andy touched on this earlier with the timescales for DC investors could be 40 years for the younger members. The timescales for DB schemes is much shorter, so they've maybe got 20-year duration left. So when you're looking at these issues over different timescales, you kind of have to prioritise things differently. For DC schemes as well, the members are generally younger, average ages are younger, and those members tend to be more engaged and want a fund that aligns with their personal interests. I mean, DC members are taking the investment risk as well, whereas on a DB scheme, it's the employer who's bearing that investment risk, and the pension scheme is bearing that risk. So the members of a DC scheme have more interest in what their investments are because they are bearing that investment risk. So you see ESG becoming more of a factor there. But it's still, DB schemes are still very much engaged with it. We're seeing some DB schemes kind of use their ESG policy, and we're seeing this in the local government space, kind of using their policy to encourage members not to opt out of the schemes. They're almost using it as a bit of a nudge tactic to make sure members stay within the scheme, which is a good thing.
Okay, thanks, Eva. That's really interesting. We just had a question in actually, which probably links to what your answer was. And Maria's asked, is ESG something that only young people care about? And obviously, I'm including myself in that. So that's over to the panel, really. I mean, do you see that sort of age thing? Does that come through? Or is it more there's sort of this impression that maybe more younger people care? But is that true? Do you see that? Anyone?
I'm happy to, I guess, give an initial view from an asset management perspective. I think, when you're constructing portfolios over the time horizons that Eva's just outlined, obviously you've got different risk return objectives for different age cohorts, right? So obviously you're thinking about volatility management for those people who are approaching retirement, particularly in the DC environment, because they're not guaranteed. And of course, you're thinking about maximising growth for the younger cohorts. So is it just the younger cohort of people that care about ESG? No, it's not, because I think for all the reasons that Ava's just outlined, this is now not a nice to have from a governance perspective. So the regulation's been I guess referenced in this call already, but since last October, all trustees of pension schemes have had to, in their statement of investment principles, have a statement around what they are going to do to manage their ESG beliefs. And from this October, they are going to have to report back to the regulator in terms of what they've done to hold their managers' feet to the fire, to make them accountable for delivering to those objectives. And in that vein, I'm delighted to say that we're very close to be able to be, I believe, first to market to offer a climate score on our default fund portfolio, and that's going to be coming out very soon with Q2 data. So I'm very excited about that. But what it shows is that actually it's not just the younger members who might be lobbying their sponsors to say, look, we need a more responsible solution to invest in. Actually, it's the people making those decisions who are typically older, more senior in their organizations, that are actually driving what their members have access to. So no, I think across the whole spectrum, ESG is gathering a lot of pace and momentum. And Eva also referenced the sort of intergenerational split, I guess, you've got between DB and DC savers. Often inside the same workforce, you've got DB and DC members. Typically, it's the older members that have access to the DB. But at the moment, we're not yet facing this huge cliff edge of DC-only savers reaching maturity in terms of taking their pots out en masse. And that, I think, is something we also need to think about, the sort of not just the accumulation defaults of how do we manage responsibly to the point of retirement, but actually also how we help manage people beyond and at retirement. That's just my 2 pence.
And I think that's a really good point, in that there's going to be this huge transfer of assets from DB schemes to DC schemes as this kind of intergenerational divide kind of moves towards the members who are younger now. And even if older members and older or people in schemes think that it's not such a big issue for them, at some point they're going to have to sell the assets of the DB scheme. And if they're sitting on loads of oil companies and they think that DC schemes will want to buy them from them, then I think there's going to be an issue. So when the transfer of assets happens, I think it's going to really come to the fore. So I think it's just something that everyone should be thinking about.
Can I just add in my thoughts on that as well, Kieron, if you like? What I found really interesting is working for a firm in the institutional part of a firm, but a firm which is basically primarily a retail investment platform. The initial impetus for ESG has all come from the institutional part of the business, from our employer clients saying this is important. The typical member of our employer-based schemes is probably about 20 years younger than the typical retail investor that we have, and that's where it comes from first. But what I found really interesting in the last sort of 6 to 9 months particularly is conversations I've had with other parts of the business where all our retail financial advisors, etc., saying, no, ESG is becoming really important for us as well. Lots of our clients across the age band are interested in it. So, the people of your age, Kieron, are probably thinking about their children and grandchildren and what they're going to grow up into.
Thanks, Paul. Okay, we've got a related question, maybe one for Karen actually, that's just come in from people watching. From Alex, has asked, for DC schemes, is the ESG a great opportunity to get people more engaged around their pensions in what their default's invested in? For example, will this encourage more members to self-select investments?
I think you're right. Whoever asked that question, you're absolutely right. All this agenda is such a good news story, or it should be a really good news story, a good news narrative. And it's a great way for a pension fund to engage with its members and just sort of share some of the fantastic opportunities that are out there to make a difference, to make the capital more purposeful in nature. So, yeah, I mean, I'm completely on board with that. And I think, with campaigns like Make My Money Matter, targeting members directly, I think pension funds can expect to be challenged more on what the default fund is investing in, and trustees will be advised to anticipate that level of increased interest and increased demand, and think carefully about how they're going to respond.
Okay, thanks, Karen. Anyone else on that one? Nope. Okay, I've had another question in from Ian saying, why don't asset managers, as primary shareholders, exert far more influence over the internal governance of the companies they invest in, especially around strategy and remuneration? So that would be, fat cat wages, I guess. Isn't this a key aspect of the S in ESG, and are asset managers doing enough?
No, I'm sensing that's coming my way. So yeah, thank you for that one, whoever asked it. So I think the short answer is absolutely, and there is an external body which some people on this call may be very familiar with, called Share Action, and the whole REMCO process of kind of board approval for executive and board pay is a thorny issue, and one that's well known and well documented. But Aviva Investors as a house is very active in this particular space, and look at the Share Action reports, is where we sit alongside other managers relative to the voting records of the influence that we exert on those conversations. It is very, very active indeed, and I think clearly some investment managers are more active or passive than others. So that's a classic example of governance monitoring, and one close to our heart as an investment house. But also it's the social too, and so absolutely executive pay needs monitoring, and if we disagree with decisions that have been made, we should vote with our feet. But the social is also important. I won't name a particular stock here because it'd be inappropriate to single one company out. But if you take a well-known electric car provider, maker of roof tiles and space projects, and think about environmentally, that particular firm is seeking to achieve some brilliant things on the E, brilliant. But from an S and a G, in terms of some of the other things that perhaps the leadership of that firm have done, in the public domain, and even in terms of the running of their own entities, do they pass that sniff test as well? So actually, you could be standout stellar on the E, but you could fail epically on the S and the G, and therefore you still wouldn't make it into the multi-asset portfolio. So I think that this is where the ES and the G being combined is really, really important to consider when you're picking stocks for a portfolio.
Thanks, Andy. Eva, on the back of that, what do you find as a consultant? Is the drive coming from the trustee, or is you as investment consultants, or is it coming from the asset managers? Or I guess the answer probably is that it's a combination of all three. But what do you find in terms of what Andy just said from a client side?
Yeah, I think that's absolutely right. I think there needs to be a demand there for investment managers to then want to go out and build funds which meet the needs of their clients. And I think the demand is coming from trustee boards who are being forced to think about it by legislation, by the government. So it's kind of all filtering down. Investment consultants as well we're putting forward ESG solutions for our clients because we believe that in the long term, ESG funds that take it into account are just going to outperform standard funds. So it's in the interests of our clients. I think Andy was making some interesting points about voting as well. So it's the ESG landscape has been very focused on equities for quite a long time. But I think it's really important to know the amount of influence that credit holders and fixed income can have on companies and their behaviour. And I think we're starting to see that more and more now, that it's not just limited to clients' equity portfolios. They're really thinking about ESG over their entire portfolio and how they can have an influence on the companies that they invest in across the board.
Okay.
And Kieron, sorry, if I might just very quickly add just one further point on that, on the sort of multi-asset thing that Ava's just mentioned. Sorry, Karen, very quickly. One of the things that we're thinking about in DC all the time is the access to the illiquidity premium. So, the fact that this could be a 50-year savings contract or beyond, how could you invest in real assets? How could you invest in infrastructure and things that actually have a much longer dated, end, if you like? And that's also a real challenge for ESG because, if you think about real assets in particular, despite any objective you might have to invest ESG, you can't get away from the fact that hundreds of tons of concrete might need to be physically poured into a structure before the returns of the electric panels it has on its roof start yielding that carbon neutral return. So, you can have every bit of desire to run a portfolio responsibly. However, you are still constrained by the natural environment in which we live. So, finding the right ways to deliver those sorts of things into a portfolio and tick other boxes that consumers want, as in accessing a liquidity premium in a responsible way, are also really tricky. Sorry, Karen.
That's all right. No, point well made. I was just going to refer to a workshop that I was running this morning. This was with a pension fund, helping them to articulate their investment beliefs. And we started by talking about what does the pension fund do at the moment, and the whole subject of responsible investment came up, and engagement and voting was talked about. And one of the people present said, well, so does engagement actually work? What evidence do we have that our engagement has made a difference? And I think that the fund management community could perhaps sort of reflect on that and think about how do you report on your engagement activity and how do you show progression over time and the fact that you are making a difference with some of your activities.
Yeah.
And if I might quickly respond to that as an asset manager, and forgive the shameless plug, but the ESG report, which we're about to deliver for our default funds, which are ESG tilted, will have exactly that. It'll actually show the voting record of how many active votes we've done. And that will tally, of course, directly with the share action pressure that we are under to make sure that we do exactly that, Karen. So, I appreciate not all managers are doing that, but just from a personal standpoint, we are.
Gold star.
Thank you. I'll shine my halo.
It's got a book coming out soon. A question that's coming a bit of a left field one, really. What impact, if any, do you think COVID has had on the thinking around ESG? Paul, maybe any thoughts on that one, or anyone else?
Yeah, I think I'll start. It could go one of two ways. I guess a lot of it, you could say, actually, we've got this one-off, really urgent short-term, hopefully short-term issue that we need to deal with. So we've got to forget everything else. We've just got to deal with everything related to COVID. Or you can go completely the other way and say, actually, a lot of the actions which are now necessary as a result of COVID, less travel, all of these sorts of things, are actually playing very nicely to the longer-term ESG, and we need to build on them. And clearly, I think the industry thinks we are going the second way there. We have had short-term issues we've had to deal with, but once we got over that immediate sort of weekly updates of what we're doing, it's now a case of thinking, okay, how do we change our lifestyles in the longer term to be more environmentally friendly as well? So I think that's definitely the way the world's going.
Yeah, thank you, Paul.
I think that the S in ESG has become more prominent as a result of COVID. So I think that certainly the pension funds I'm talking to, I've noticed, so the way I work with pension funds to help them with their investment beliefs is to use the SDGs as a framework. Not that I'm sort of particularly attached to the SDGs and I know the limitations of the sustainable development goals, but it's a helpful framework. And what I've noticed since COVID has come in, because what I do is get them to prioritise 3 to 5 sustainable development goals that they feel are going to have an investment impact on the portfolio. And so they therefore need to shift their investment strategy to be more aligned to those goals. And what I've noticed since the start of the pandemic is an increasing number of them are starting to mention things like health and well-being, for example, as a goal. So I think that there's going to be more focus now on social, and I don't think it's going to diminish the interest in the climate agenda, but I think it's just going to bring it back up, and perhaps we will be a bit more evenly balanced going forward, which is great.
Okay.
Kieron, if I might, just very quickly from an asset management perspective, I think the way in which we manage money, particularly for DC savers, of course, again, depends on sort of different age cohorts. So I guess there's 2 points to this. One is the capital market movements and market volatility generally. So that's a brilliant thing for young savers. So young savers who are employed, who are keeping their contributions going, guess what? They benefit from pound cost averaging and compound returns when markets recover over the long term. And that will exponentially the units that they buy in their unit funds. Conversely, of course, the people that were planning to retire this year, if you've crystallized unit linked fund withdrawals at a time where, like March, where the markets were 30% underwater, you've just exponentially decreased the shelf life of your overall pot exponentially, which you might not ever recover from. So for me, this shines the spotlight for DC savers and for fiduciary managers and also for pension schemes to think about sequencing risk in particular, and how and when you might create liquidity for savers and how they might use that with the platform constraints we have around unit-linked products.
Thanks, Andy. Okay, right, in the conscious of time, final question to the panel. So you've got one answer each here. I think as we've discussed over the last 5 years, there really has already been a huge amount of change within this responsible investment space. So I guess a quick question would be, what do you think it's going to look like in 5 years' time? And putting you on the spot, if you had to choose one thing you would like to see the most, what would it be? Take your pick. Whoever to go first.
I'll go first. I don't mind being first. Where will we be in 5 years' time? Well, when I set up Pensions for Purpose, I set myself a personal goal. And that goal is to see at least 5% of pension fund assets allocating to impact investments. These are the dual goal, intentionality, purposeful investments. And so it would be great if I felt I could retire in 5 years' time. I'm certainly hoping that I can retire by 7 years' time. So I think that where we're going to see is a significant shift of pension fund assets along the spectrum of capital. At Pensions for Purposes conference last year, over 90% of pension funds said that they thought they would be investing sustainably and impactfully in 3 years' time, and 72% said they would be investing impactfully. So yeah, that's my vision, is that significant shift in capital. And then what was the second question, Kieron?
I think pretty answered it. What was the one thing you'd like to see most out of that, which you may have answered, but yeah.
Well, yeah, I mean, I think the one thing I would like to see that isn't there at the moment is more consistent regulation, actually, across the different types of pension fund investors.
Do you want to say more regulation?
Yeah, well, just clearer messaging around what can pension funds do in terms of this agenda. Yeah. What can they do that's consistent with their fiduciary responsibilities? So that would be my desire.
Okay. Paul?
Yeah, so as I say, so ESG has gone from niche a few years ago. It's now very much right in the mainstream. What I think is going to happen in the future, and quite like to happen, is it almost goes off the agenda, but in a really good way, because it's taken as read that everybody is taking ESG risks into account. So no investment decisions are made without thinking about ESG risk alongside political risk, economic risk, credit risk, all of the other risks which investment professionals have been looking at for many years. So it's almost, it was small, then it became large, and then it's a way of life. So we won't need specific webinars about ESG anymore because it'll all be out there. We'll all be doing it that way. So.
Answer, Paul. Anything to get out of a webinar? Eva, any thoughts?
Yeah, no, I've got to agree. I kind of hope it becomes so mainstream that we don't really think about it so much anymore. I'd hope that instead of so take passive investing for an example, people aren't investing in standard passive indices anymore, and all the money's going into ESG passive indices, and so that just becomes the norm. And I think that'd be great. I think to kind of touch on something Karen mentioned as well, I think data needs to be better and more consistent from companies on their carbon emissions and kind of their S and G data as well. I think a lot of consistency in data there would just help the whole industry to make decisions between which companies to invest in, and I think it just brings more clarity to everything.
More transparency.
Yeah, exactly.
Okay, and Andy.
So I think my answer is slightly similar to Ava's, but with a slightly shift in emphasis, and I'll answer it in reverse, because what I'd like to see is the market move away, and I mean the DC market in the UK, move away from its sort of unnerving sort of drive towards race to the bottom and cost. Because I saw something last week that effectively we've already now got passive assets in UK DC for free, literally at no cost. But if those same passive funds are contributing towards the 6-degree world, then there ain't no planet left. So I think now what we're seeing is that consumers are prepared to pay more for something that's demonstrably better. And don't get me wrong, the emphasis on managers is there to prove that we can construct and build and manage something demonstrably better. So that's what I'd like to see. And then in 5 years' time, I agree wholeheartedly with the consensus of the panel that there's no getting away from ESG. It's not a nice to have anymore. It will happen. But what I'd like to see is multi-asset and portfolio construction done where there are universal benchmarks applied that aren't proprietary scores of any individual houses that have had to invent themselves. Organizations like Kieron's or TCFD or whoever else are actually helping set the benchmarks and what they should be and what good looks like in order for us to manage to those standards responsibly. And effectively consumers buy into that, and effectively the world will move ESG, no question. That's what I think will happen.
Okay, well, thank you ever so much, Andy, Eva, Kieron, Paul. And our time is now up, but I'd like to say a huge thank you ever so much for your insightful views this afternoon, and also for everyone joining us. I hope you found it, and we certainly look forward to welcoming you on the next edition of BWD's Boardroom series. Thank you very much.